Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to InvesTips from the CIO's desk. I'm Steve Brice, Global Chief Investment Officer at Standard Chartered. And today I'm going to try to help you make sense of one of the most talked about developments in finance, digital assets. Over the past few years, you've probably heard terms like Bitcoin, cryptocurrency, NFTs, and blockchain. For many people, these can sound complicated or even intimidating. But the reality is that digital assets are becoming a growing part of the financial landscape. So it's worth understanding what they are and what risks they carry. So let's break this down into three things. First, what are digital assets? Well, digital assets are simply assets that exist electronically. They can represent money, investments, ownership rights, artwork, or other forms of value. Unlike traditional assets, they don't exist in physical form. Instead, they are stored and transferred digitally, often using a technology called blockchain. Now, a useful way to think about blockchain is as a highly secure digital record book. Every transaction is recorded, visible across the network, and extremely difficult to alter after the fact. And this allows people to buy, sell, and transfer assets without relying on a central authority to maintain records. So secondly, what are the main types of digital assets? So firstly is central bank digital currencies, or CBDCs. These are digital versions of traditional currencies issued by central banks. Think of them as a digital form of cash. Their value is backed by governments and they're designed primarily for payments and transactions rather than investment. Second category is cryptocurrencies such as Bitcoin and Ethereum. These are digital currencies that operate on blockchain networks. People can buy and sell them, and some investors see them as a new asset class. However, their prices can move dramatically, sometimes in a very short period of time. And finally, there are non-fungible tokens, or NFTs. NFTs are digital certificates of ownership attached to unique items such as digital art, music, or collectibles. Unlike cryptocurrencies, which are generally interchangeable, each NFT is unique. Their value depends heavily on what buyers are willing to pay, making them highly speculative investments. So third, what should investors keep in mind? Well, digital assets are exciting because they bring innovation, new business models, and potentially new investment opportunities. But investors should also be aware of the risks. Prices can be extremely volatile. Regulations continue to evolve. Markets can be less liquid than traditional investments, and there are cybersecurity risks such as hacking or the loss of access rights. In addition, some digital asset markets offer fewer investor protections than traditional financial markets. Now, this doesn't mean that digital assets should automatically be avoided. It simply means investors need to approach them carefully, understand what they're investing in, and ensure any exposure fits within their overall financial goals and, importantly, risk tolerance. So in conclusion, the digital asset world is still evolving rapidly. Whether digital currencies, blockchain technology, or tokenized assets become part of everyday investing, one thing is clear: innovation is reshaping how we think about money, ownership, and financial markets. As with any investment, knowledge is your best starting point. Thank you for listening to InvesTips from the CIO's desk. I hope you found today's discussion useful. Join us next time as we continue to explore practical ideas that can help you make better financial decisions and build long-term wealth. Until then, thank you for listening and take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.